You know, when you think about a company's inventory, you probably just picture a big warehouse stacked to the ceiling with boxes. Seems pretty straightforward, right? Well, what if I told you that some of those boxes don't actually belong to the company that's holding them? Or that the company also owns a ton of inventory it can't even see, sitting miles away in someone else's building? It's true. So in this explainer, we're going to pull back the curtain on the hidden rules of inventory, 4 really clever strategies that show how your stock can be a surprisingly powerful and flexible asset.
All right, here's our game plan. First, we'll dive into how you can sell products you don't even own yet. Then, we're going to talk about managing stock that's not even in your building. After that, we'll see how inventory can literally be turned into cash. And finally, we'll tie it all together by decoding the financial disclosures that make sense of it all.
So let's kick things off with a classic business dilemma. You've got this amazing product, but getting it onto the shelves of major retail stores, that's super expensive and honestly pretty risky. I mean, what if it doesn't sell? You're the one left on the hook for all those losses. Well, this is exactly where the very clever world of consignment inventory comes into play.
Okay, so here's how a consignment deal works. You have the supplier, we call them the consignor, and they send their goods to a retailer, the consignee. But, and this is the absolute key, the supplier holds on to ownership of those goods. The retailer is basically just displaying them. Ownership only changes hands at the very last second, right when a customer swipes their card at the register.
Let's make this crystal clear with a quick example. Imagine ABC Furniture is our supplier, our consignor. They ship $10,000 worth of really nice tables over to Trendy Store, who's our consignee. Now, Trendy Store gets to put these awesome tables in their showroom and sell them without ever having to buy them first. And for their trouble, they'll get a nice little commission on every single sale.
So how does the accounting actually shake out? Well, for the supplier, ABC Furniture, it's kind of like a two-step dance. First, when they ship the tables, they don't record a sale. Nope, they just make a little note on their own books, moving the inventory from their regular inventory account to a new consignment inventory account. It's still their asset, they're just tracking it in a different spot. Then, the moment Trendy Store sells a table, bam! ABC finally records the revenue, the cost of that table, and of course, the commission expense they owe to Trendy Store. And what about Trendy Store? They don't touch inventory on their books at all. They just record their commission income when the sale happens. Simple as that.
Okay, so that's one scenario. But what happens when your own warehouse is just bursting at the seams? Maybe you got a massive seasonal order, or maybe your products need some kind of specialized storage that you just don't have. This brings us to our next topic, managing inventory that's being held at third-party locations.
This is actually a super common strategy. You can pay to have your stuff stored at a public warehouse or with a specialized processor, but you still own it. You still control it. The physical location doesn't change who owns it. And this really drills down to a fundamental rule in accounting. If you hold the rights and you bear the risks of ownership, it belongs on your balance sheet no matter where in the world it's physically sitting.
All right, so that brings up a really good question, right? Since all this inventory isn't even in your building, do you have to do some kind of special, complicated accounting entry to track it? What do you think?
And the answer is, nope, not at all. The accounting entry is exactly the same as if the inventory was in your own warehouse. The secret sauce here isn't a journal entry. It's all about transparency. You have to disclose in the footnotes of your financial statements that a certain amount of your inventory is being held off-site. This is absolutely critical for investors and especially for auditors, who are definitely going to want to see those warehouse receipts to prove the inventory is real. Now, let's pivot to something every business on the planet thinks about: cash, specifically working capital. A lot of the time, the biggest asset you have is just all that inventory sitting there. So the big question is, how can you turn that stock into cold, hard cash without actually selling it?
Well, there are 2 main ways to pull this off: financing and pledging. Let's look at the left side here. Inventory financing is an active loan. The bank gives you cash and they use your inventory as the direct security for that loan. It's a very hands-on deal. Now, on the right, you've got pledging, which is different. You're not taking a loan directly against the inventory. Instead, you're just using it as general collateral for some other loan. It's basically a legal promise to the lender that, hey, if I default, you get this inventory. That promise puts restrictions on what you can do with it. So you see the difference? Active borrowing versus a more passive, restrictive promise.
Let's drill down into financing for a second. A lender is not going to give you 100% of your inventory's value. That's too risky for them. They'll give you what's called an advance rate, which is usually somewhere between 50 and 80%. So for $100,000 of inventory, you might get a $60,000 loan. The journal entry is super simple.
Debit cash, because you got cash, and credit notes payable, because you now have a loan. But here's the trade-off. The bank basically becomes your new best friend. They're going to want monthly inventory reports, and they might even send their own auditors to your warehouse to count your stuff.
Whew, we have covered a lot of ground. Consignment, third-party storage, financing, and pledging. So now, let's bring it all home. We're going to wrap this up, decode what it all looks like on the financial statements, and give you some practical tips you can actually use.
Okay, this table is perfect because it puts everything side by side. For consignment, remember, the inventory stays on the supplier's balance sheet. The only entry is just moving it to a special consignment account. For third-party inventory, it's on your balance sheet, but no special entry needed, just a disclosure. With financing, both the inventory and a loan are sitting right there on your balance sheet. And for pledging, no change to the balance sheet itself, but you absolutely need that critical footnote disclosure. See how each one has its own unique financial fingerprint?
So what are the big takeaways here? What are the rules of the game? First, if you're doing consignment, your contract is everything. Spell out the commission, the payment terms, what happens to stuff that doesn't sell, all of it. Second, for third-party inventory, always be ready for your auditors. Get those confirmations from the warehouse. Third, and this is a big one, if you're financing, keep a very close eye on those advance rates. If your inventory value drops, the bank might call and ask for a payment. And finally, good software is your best friend. You've got to have a solid system to track all of this.
And so, we end on this thought. Inventory isn't just a static number on a balance sheet. It's not just stuff sitting on a shelf. It's dynamic. It can be a tool for breaking into new markets, a solution to tough logistical puzzles, and a source of cash when you need it most. So the real question is, are you listening to what your inventory can do for your business?